I mean, I think that $1 million Bitcoin is in the cards because I do think that Bitcoin could be as large or larger than gold. And I think gold's probably going to increase its market share as well. I mean, it's been doing well in recent years, and I'm still bullish on gold. So I think that both gold and Bitcoin, I think, are going to have a little more prominence in the years ahead. And Bitcoin at $1 million is only a 20 trillion dollar market cap, 21 trillion fully diluted. So it's not really that big of a market, especially over time when you include another 6 years of inflation and money supply growth.
Renowned macro analyst and investment strategist Lyn Alden is widely known for her brilliant and detailed analysis of the macro environment, core Bitcoin fundamentals, and related topics. As a sound money advocate, Lyn is super bullish on gold and Bitcoin and has often described the leading cryptocurrency as the hardest money there is. Though Lyn often refrains from making price predictions, she has always maintained that she believes Bitcoin's price will continue to rise until it's someday worth hundreds of thousands of dollars. In a recent interview with Altcoin Daily, Lyn ups this prediction, giving a super bullish $1 million price prediction for Bitcoin in the coming years. When asked if she agrees with Cathie Wood's $1 million prediction for Bitcoin by 2030, Lyn explains that she definitely sees Bitcoin hitting $1 million per coin someday. However, she has a slightly longer time frame than the ARK Invest CEO. According to Lyn, the current global fiat-based monetary system is doomed and heading for some very uncertain and chaotic times. As such, Lyn envisions hard assets like Bitcoin and gold having more prominence in the coming decade as investors, including nation-states, sovereign wealth funds, large hedge funds, and multi-million-dollar corporations, start loading up on both assets to avoid the inevitable and constant devaluation of fiat currencies. During her discussion with Altcoin Daily, Lyn explains that macro indicators like changes in global liquidity impact Bitcoin prices more than core Bitcoin fundamentals, like the 4-year halving event. With central banks led by the US Federal Reserve now easing off on their stringent quantitative tightening policies, Lyn is anticipating a massive appreciation of Bitcoin's price in 2025 and beyond. We will bring you clips from Lyn's interview, but before we do, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks for watching and enjoy the video.
So I put less emphasis on that than others. I mean, obviously over time, the halvings are important because the new supply coming to market is relevant. So as that goes down, that is relevant. But I generally view global liquidity as being more impactful. I've done analysis. Actually, I have a report coming out with a colleague, and we did analysis of liquidity correlations, Bitcoin versus global liquidity, and then also other assets compared to global liquidity. And it does turn out that in any given 12-month rolling period, Bitcoin is more correlated with global liquidity than any other of the major assets that we do. So stocks, bonds, gold, foreign stocks, things like that. They're not, many of them are just to varying degrees correlated with liquidity, especially stocks. But Bitcoin is the most correlated with liquidity. And most of those highs and lows are associated with liquidity rising and falling. And the two major components of liquidity, the way I measure it, one is basically the rate of global credit creation. And then the other factor would be the strength of the dollar relative to other currencies, which is relevant for what we talked about earlier, which is that a lot of countries in the world have dollar-denominated debts. That's kind of the unit of account for a big part of international finance. And so whenever the dollar is strengthening, that's actually putting a lot of pressure on global liquidity. Whereas when the dollar is weakening compared to other major currencies, that's actually pretty positive for liquidity. So I think a lot of the correlations that people associate with the 4-year cycle are actually liquidity, which kind of is overlapping with it, even though I do think that there also is some relevance from the halving.
And you believe global liquidity is increasing next year. Where does that put Bitcoin?
As a base case, I would expect higher. I'd say next 18 months or so. It's hard to time things precisely. We are generally seeing, as the Fed starts to cut interest rates, we're seeing a softer dollar. It doesn't mean it's going to be a straight line, but basically some like the catalyst that kind of really propped up the dollar are kind of fading. And the dollar, the United States runs a structural trade deficit, which for most currencies would be very weakening for their currency over time. But the United States is also a global reserve currency, so we have all those dollar-denominated debts around the world, and all of that represents inflexible demand for dollars. So there's this balancing point. Whenever we tighten monetary policy, we actually are pretty capable of strengthening the dollar. Whenever we loosen monetary policy, that tends to be pretty dovish for the dollar. And so because I expect a somewhat weaker dollar, and I expect probably going back to more global credit creation by next year, probably the year after that, I think we're entering another upward liquidity cycle after really like 2+ years of kind of being range bound in liquidity. So Bitcoin has followed this liquidity cycle pretty closely, and my base case over the next 18 months is probably for both liquidity and Bitcoin to go up, although I don't really have a view of, say, the next 3 to 6 months. I mean, these are processes that take time to play out. I'd be surprised if we don't see 100K. I mean, that's kind of like a back of the envelope rough expectation where I would think that the cycle would be, I would consider the cycle stunted if we don't reach that. But other than that kind of rough level, I mean, there are easy scenarios that you can imagine, over the next 18, maybe 24 months, you can have a wall of liquidity and institutional buy-ins and some sovereign announcements, and you can get the crazy numbers. Or you could barely get over 100K if you even make it there. So I don't really have views because I didn't have to predict not just liquidity, but like what individual nation states will do, or like, whether there's gonna be like another MicroStrategy that decides to come in. So it kind of comes down to like one billionaire's decision or not, right? So rather than price targets, I try to just have a sense of direction and kind of long-term prices that make sense, not any one cycle.
The Fed's rate cut announcement has been met with conflicting reactions from prominent investors and analysts. Speaking at a conference on Wednesday, former Bitwise CEO Arthur Hayes heavily criticized the Fed for considering a rate reduction despite the increase in dollar issuance and out-of-control government spending. He said, "I think that the Fed is making a colossal mistake cutting rates at a time when the US government is printing and spending as much money as they ever have in peacetime. While I think a lot of people are looking forward to a rate cut, meaning that they think the stock market and other things are going to pump up the jam, I think the markets are going to collapse a few days after the Fed's rate cut." Lyn agrees that the central bank's pivot, though widely expected, is not the best move for the US economy at the moment. Instead of the pivot and the generally dovish remarks from Fed officials on Wednesday, Lyn believes the US government should be looking into an austerity program that could help slow down the coming fiscal dominance train, which Lyn says threatens the entire global financial system. She also talks about the stock market, pointing out that top indexes are only being carried by a few names, indicating that the economy is far from strong and resilient. Let's get back to the interview.
If you were Jerome Powell for 1 year and you could do exactly what you wanted, what would you do rate cut wise for the next 12 months?
Yeah, there's two answers to that question, because in one sense, I think that the fundamental algorithm that they work with doesn't make sense. So, for example, I don't think central banks should set interest rates. I don't really believe in price controls, and they set price controls for the price of money. So I kind of fundamentally reject the whole concept. But if I were Jerome Powell and I had a dual mandate of trying to maximize employment and trying to keep inflation in check, I would probably do mild rate cuts. I think he's basically trying to balance his mandates. I lay more blame for kind of some of the current situations on earlier heads of the Fed. So during the Greenspan era, the Bernanke era, that's where I think that they could have done significant things differently. But ever since the global financial crisis, I view a lot of this as like locked in now. So I don't, I think that I would not really fundamentally do much different than him. I guess the one thing I would do differently is I'd be more transparent about the deficit being an issue. During the pandemic, basically the central bank is supposed to be independent. And during the pandemic, he made the rare move of saying that the economy needs more fiscal support. So, he can only do monetary policy. He's saying we need more fiscal support. And we got that in spades. And, we eventually got inflation from it. And now that we have ongoing, very large fiscal deficits, whenever he's asked about the deficit, he basically says it's not my area to comment on. Instead of, if he was being more symmetrical with his kind of, occasional public recommendations, I think it'd be prudent for him to say, look, it's really hard to do my job on inflation when you're running 7% of fiscal deficits, compared to GDP in a non-recession environment. Like that's the source of where a lot of this inflation's coming from. But he's kind of too like now he's suddenly going back to never wanting to talk about politics, even though he has in the past called for more fiscal support. I don't have a strong view about the next year. I think the stock market is rather expensive, especially the large ones. When the stock market's strong, people often assume it's like very risk-on behavior. The ironic thing in this case is it's kind of a bubble in risk-off assets, which is to say that there's not much interest in cyclicals. There's not much interest in emerging markets. There's not much interest in Bitcoin from kind of the broader space. There's not really an interest in those types of assets. Gold has outperformed the S&P 500 over the past 3 years, mildly. If you kind of like look at S&P 500 priced in gold, it's been this like slow rollover. The names that are doing really good in the stock market are the trillion-dollar profitable monopoly tech stocks. That are basically the low risk stocks. Costco is trading at like 55 times earnings. It's like this bulletproof blue chip company. And every investor says, I don't want to touch banks. I don't want to touch energy. I don't want to touch emerging markets. I don't really want to be in anything cyclical. I want to put all my money in big cap tech and Costco and stuff like that. And that's actually, and the funny thing is that gets dangerous because not that Costco is going to have a problem, but you can have a scenario where it goes down from 55 times earnings to 35 times earnings, and the stock underperforms the fundamentals. So right now, I think a lot of this stock market doing well is actually, ironically, somewhat risk-off behavior. I'm a little bit more interested in the less expensive, choppier areas of the market, whereas I am somewhat concerned about these big, expensive areas that are, I would say that many of them are bid to price levels that don't really match their fundamentals.
Whether the Fed's pivot will be hazardous or advantageous for the markets and the overall global economy in the long run remains to be seen. However, Bitcoin and other crypto asset prices have picked up sharply since the Fed's announcement, with the leading cryptocurrency now trading above $63,000 per coin, a 10% increase in the past week. Among the top cryptocurrencies, Solana and Avalanche are also showing some promise, gaining over 7 and 6% respectively in the past 24 hours and 13 and 17% in the past week. The upside rallies are expected to continue and intensify further in the coming weeks and months as major central banks announce more rate cuts and fully resume quantitative easing. Please share your thoughts on Lyn Alden's $1 million prediction for Bitcoin, as well as on her analysis of the current state of the US and global economies. For more videos like this, please give this video a thumbs up, subscribe to the channel, and turn on post notifications for more videos. We appreciate the support and hope to see you in the next one. Thanks for tuning in.